What if I told you that there's a way to protect your portfolio and create consistent cash flow without trading a single option yourself? Most investors have no idea that this strategy even exists. Let me show you how it works with two newer ETFs that could truly change the way you invest in 2025. Hey, this is Mark Soberman, the founder of Netpick. I'm looking forward to sharing this opportunity with all of you. So let's get started. Are you feeling worried about the market's wild swings? Obviously, you're not alone. Finding the right balance between safeguarding your investments and still creating consistent cash flow isn't a walk in the park. Imagine a world where you can have both to protect yourself from market falls and still make money. The good news is what I'm going to share with you today, you can truly do this. It's thanks to a newer ETF strategy which incorporates hedging along with cash flow. Now, we all know what happened recently in the markets, right? In the mid-February, we were up here, and this is the NASDAQ 100. In a very short amount of time, it plunged about 25%, which means there was many individual stocks that actually dropped 25 to 50% or more in this time, and it happened really quickly. So what if there was a way to hedge against some of this downside, and also along the way, when these markets are declining like this, you could still generate for yourself reliable and regular income? Now, I know ETF hedging, it might sound fancy and complicated, but it really isn't. It's just a way to protect your investments and have some protection in a rainy day. Think about having an umbrella if it's raining outside. It's like your safety net. But what I love about cover call ETFs is you can actually create and generate cash flow, including even on a weekly basis, but certainly on a monthly basis in investments, whether they go up or down. So let me introduce to you two ETFs that you may want to consider, and then I'll also share with you how these work. And these come from NEOS with multiple billions under asset management. And the two are QQQH, and I'll share with you in a moment, SPYH. They're just as easy as buying any stock. It's an ETF. This one is based, of course, upon the NASDAQ 100. When the NASDAQ goes up, it will benefit this ETF. The same with the SPYH. One thing that's special about this, I point you to right here, is there's almost a 9% distribution rate, meaning you can pay yourself out, and this is paid on a monthly basis. I've divided up, of course, amongst the 12 months, but that's a way above average yield. I think you would agree if you do anything in dividend stocks or dividend ETFs, 9% is well above the typical averages. But the second thing the QQQH does is it actually hedges some of the downside. It does this with an option strategy. Now, you don't need to execute any of the option strategies that create the income, the covered calls, or any of the downside protection. That's done all for you automatically. The same goes on the SPYH, and this is newer, and it's also based upon the S&P 500 in this case, and it will probably have somewhat similar yields, maybe slightly lower, because there's lower volatility typically in the S&P 500, but it also will have downside protection. Now let me jump back over to the QQQH, and you can see every single month it is giving a distribution based upon how many shares that you have, and it tends to be fairly steady over time. If we looked at the 2024, you can see pretty steady for the entire year. Lately, it's been higher, but we don't know if that'll stay that way because volatility went way up. The nice thing is if volatility does go up in chaotic markets, your income actually tends to be above average. So we don't know how long this will last, May, June, July, who knows, but on a steady monthly basis, you get a distribution. Now, the cool thing with that distribution is you can choose to withdraw that as cash and spend it on anything you want, whether it's bills, a vacation, anything you need, or you can reinvest that and buy more shares and have automatic dollar cost averaging on the QQQH. What happens a lot of times is people will bail out because you're losing a lot of money, right? And you don't know when it's going to stop, but then they miss out on recoveries like we've seen over the last few weeks. So imagine if you were getting regular cash flow, if you also had some hedge against the downside, don't you think you more than likely could have weathered this decline and probably been a lot less emotional about it, and also more than likely stuck to your investment? All right, so let's talk about why you may want to consider the QQQH and also some of the downsides, of course, as well. This is a line chart, very similar to a regular bar chart. We just take out the high and the low. This is just closing prices from mid-February to current time when I'm recording this. The line on the top is the NEOS ETF that we're introducing. The line on the bottom is the QQQ, the NASDAQ 100. Notice the decline in the NASDAQ 100 during that time on a closing basis was about 23%. It was actually 25% from high to low. Notice the decline on the NEOS ETF was quite a bit less. It was about a little bit under 15%. That's about a 50% improvement on the decline. Now, no, you cannot prevent the loss. There are other ETFs that I'm going to introduce to you in the next video that can actually eliminate virtually all of the loss, and that's buffered ETFs, but that'll be the next video topic. But in this case, we were able to hedge the downside and take a lot smaller loss on paper. Remember, we don't lose anything if we don't sell. The cool thing about these ETFs is we got distributions. We got one here in February, one in March, and one in April. Again, what it's going to enable you to do is take that money out if you need to, invest in something else, pay expenses, or you can do what we typically suggest if you can, compound it, reinvest it, get more shares of QQQH, and get the benefits of dollar cost averaging without having to put more capital in. You just use those distributions to buy more shares. Now, let me point something out. In the long term, if this goes on a bull market tear in the NASDAQ 100, I do expect the QQQ to eventually cross over and have a higher total return. Because remember, when we're using covered call options, we are giving up some upside. There's always a trade-off in investing. But the exchange is you're hedging downside. So if we end up going back down again and nobody knows what's going to happen next, the same thing's going to happen. You still would have the reliable cash flow to do with what you want, and you'll be able to hedge some of that downside. You're much more likely, I believe, to stay with that investment. And over the long term, the NASDAQ 100 has proven to be a very good investment, but it's extremely volatile. It's prone to large drawdowns. This is a way potentially that you can stay in the market longer. The same is going to happen on the SPYH. If we compare the S&P 500 to the SPYH from NEOS, you're going to see the same behavior. You will lose less in the decline, but in between, you're going to get cash flow on a regular basis, and I believe you'll have less drama, less stress, and you'll be able to stay with the investment longer. The last thing I'm going to suggest is go to netpicks.com/income now. I'll put the link on the screen and in the description down below. I want to share strategies like this and a whole bunch more, including some that make double to triple the cash flow that I just shared with you. Yeah, truly 20%, 30% or more. So you have even more flexibility. Plus, what's missing from what we're sharing today is market timing. What if you could get out before these large sustainable declines that sometimes can last 6 months, 12 months, 18 months or more? So I like to add market timing into my passive cash flow investing with ETFs. If you go to this page, you just put your email in. There's no obligations. It's completely free. It puts you on a wait list and gives you a lot of nice benefits for when we release the ETF Income Accelerator, which only comes out a handful of times per year. This will get you to the front of the line and will give you first option, and I can share all the additional details with you. No obligations, it's completely free, but I suggest you go there, put your email in, and this way you'll be informed when the market timing model comes out, and I can share with you a lot more strategies which will have potentially higher cash flow as well as even more hedging. Look forward to seeing you over there, and then I'm going to be sharing some more videos here coming up on buffered ETFs, much higher yielding ETFs, and other ways to develop passive cash flow. If you have any questions, more than happy for you to put those in the comments down below, and I will personally answer all of your questions.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review Netpick's full risk disclaimer and privacy policy.